Hello and welcome to this week's video tutorial for Heriot-Watt University Trading and Investment Club. Today we'll discuss the concept of asset classes. Asset class is simply a group of securities with similar characteristics and behaving similarly in the marketplace and are subject to the same laws and regulations within one country. We have 6 major asset classes, and those are equities, fixed income securities, cash and cash equivalents, real estate or properties, commodities, and financial derivatives. Starting with equities, also called stocks or shares. Equities offer part ownership of a company and therefore a claim on a company's future earnings. When you buy a share of a company, you are becoming a part owner of that business. When the company does well, your share may go up. When the company performs poorly, your share may go down. Some companies pay dividends, which are payments of earnings by a company to its shareholders. Dividends, however, are not mandatory, and therefore not every company decides to pay dividends. Some companies in early stages of development decide to retain all their earnings for future growth. You can earn a return from investing in shares in 2 ways. If the share price increases and you sell the shares for more than when you bought them, or through dividend payments. In terms of risk, equities are the most risky assets of all. On the risk-reward matrix, equities are on a top right corner. Second asset class is real estate. Investment in real estate property refers to commercial premises that generates return in form of rent and appreciation of the value. You can invest in real estate through real estate investment trust or ETFs, REITs or real estate investment trusts. Third asset class is money market vehicle or cash equivalents. Cash equivalents are assets that are easily convertible into cash, such as short-term government bonds, T-bills or commercial papers. Cash equivalents are distinguished from other investments as being extremely liquid with very short-term existence of up to 3 months. On a risk-reward matrix, these assets are near the bottom as the least risky. Fourth asset class are fixed income securities, also called debt or bonds. Those are simply IOU with obligations for the borrower to make a fixed amount payments called coupons and pay the face value of the bond at the end of the agreement called maturity date. In terms of riskiness, bonds are relatively riskless, placing them somewhere between cash equivalents and equities. Fifth asset class are commodities. Commodities are simply marketable goods produced or extracted to satisfy needs and wants. Commodities are divided into hard and soft commodities. Hard commodities consist of gold, silver, copper, oil, while soft commodities include tea, coffee, cocoa, sugar. The main drivers of commodity prices are supply and demand and speculations. Commodities are used in financial markets to hedge off the risk of equities or inflation. They are not, however, long-term source of reward. The last class of assets are financial derivatives. These are financial instruments that derives its value from underlying assets, index or interest rate. It has no intrinsic value in itself. Financial derivatives consist of variety of products like swaps, futures, options. That's everything for today. Thank you very much for watching, hope you've enjoyed that, and see you next week.